Welcome again to another day on the Fortune Signatures training, Forex training scheme on a basic class. Um, this is Fortune Signature. Welcome again. It's all about building a fortune, trading Forex. And we had a very um, eventful first day of training, talking about quite a number of things. We talked about, of course, what Forex is all about and why trade Forex and what you must know about the Forex market. And we also looked at some of the currency pairs that are being traded in the Forex market, talking about the exotic, the majors, and the crosses too as well. We're supposed to start talking about the types of traders that exist in Forex, types of traders that exist in Forex. Remember, guys, Fortune Signature is a hub of independent and consistently profitable traders with proven signature trades that steadily guarantees a fortune. Okay, so let's see how we can help you. It's all about ensuring that we build a fortune trading the Forex market. Okay, you should have downloaded your MT4, that's the method trader. You should have downloaded Telegram by now, being a part of the Telegram group. For those of you that asked questions from the very first class, I hope we're able to successfully, answer your questions effectively. All right. Of course, the Zoom app is another for us to get familiar with online meetings as the case demand. And I trust you all have been reading your Candlestick Trading Bible. It's very important, though. You need to read the Candlestick Trading Bible for us to, probably play along on the same frequency. Okay, so today we'll be looking at types of Forex traders. Types of Forex traders. Contrary to, general opinion that always says, okay, types of Forex traders are the scalpers and, all the swing traders and all the likes. No, types of Forex traders, we have them in three categories. We have the commercial traders, we have the non-commercial traders, and we have the retail traders. All right, the commercial traders, the non-commercial traders, and the retail traders. The retail traders sometimes love to call them the retail heads because most of the time they tend to always think in the same direction. So what are commercial traders? Commercial traders refer to traders who aren't trading the Forex for profit. No, they're not doing that. They're doing it to stabilize and balance the economy. All right, I'm talking about manufacturers, industrialists, I'm talking about farmers, I'm talking about central banks too as well. All right, so sometimes when you hear statements like the Central Bank of Nigeria just pumped, about 200 and something, billion, naira or $1 billion into the Forex market, it's not because they have done it to make money back in return. No, they've done it only specifically to stabilize the economy. What about non-commercial traders? Non-commercial traders refer to, the hedge funds, the multinationals, the commercial banks, institutions, investment banks, and they're doing this for profit. They are the big boys. They are the big players in this game. They are the ones that really, really move the markets. You can almost call them the market makers, as it were. They're the ones that, determine volume, the direction of a particular market at a particular time, okay? And of course, we also have the third category of traders that actually talk about you and I. Yes, these are the retail traders, or you could call them the retail heads. These are individuals like you and I who make up small segments trading a part of the large foreign exchange market, and all we do is just speculate on exchange rates between different currencies, all right? And this segment has developed over the years with the advent of dedicated electronic trading platforms. We mentioned that earlier, which is the MT4, given by brokers, okay? Before, it was difficult for the retail traders to be a part of the game. You needed to have hundreds of thousands of dollars to be able to trade in the Forex market like the big boys. But now it's been simplified such that even with $10, $50, $100, people are playing in the game with the help of the brokers, the Forex brokers. Okay, and of course the MT4 platform, very much on internet, allows individuals to access the global currency market from one spot. So remember, commercial traders, non-commercial traders, and the retail traders. These are the three types of traders that exist. So the ones that you've actually known in terms of the terms that you've heard before, like scalping and day trading and all, that refers, or those refer to the trading types. These are the trading types. You know what that means? It means that even the retail traders or the non-commercial traders, as it were, are the types that are types of traders that can deploy any of these trading types. Okay, they can deploy any of these trading types. The first trading type we'll be looking at is the scalping trading. Okay, scalp strategy, as it were. Okay, scalping. And for scalpers, basically, they hold onto trades for only short periods of time. These people, you can't call them quote unquote people that can lead trades for days. No, it's short periods of time. Their main objective is to grab every small amount of pips, okay, as many times as they can throughout the busiest times of the day. That's their plan. That's what they're looking out for, right? For the day traders, deploy a different method. It's more like a method of buying and selling, securities within the same day, currencies within the same day. The positions are closed out within the same day that they are taking. They don't leave their trades overnight. They leave no positions to run overnight. The day traders want to see their profits by the close of the day, okay? And the close of the day for Forex traders refers to 10 p.m. that day. Do you understand that? 10 p.m. that day. What about swing trading, which is another type of trading? Swing trading are for those people that like to hold on to trades for several days at a time. These ones, oh my, they have too much patience. These types of traders can't actually, they can monitor their trades or their charts throughout the, they are kind of people that can't monitor their trades throughout the day, so because they're probably busy. So what they do is dedicate a couple of hours just analyzing the markets, maybe every night, like 10 p.m., when the market is closed for the day and the new day has begun. They just analyze the market, look at the direction it's going, and speculate, and they take a position. All right? So during the day, they're busy doing every other thing that they want to do. So that's why I said, as a Forex trader, you must be able to enjoy time. They are still enjoying the time of being able to get into the trade whenever they want, despite having a busy schedule. All right, remember, you must enjoy time as a Forex trader. You must be able to enjoy leverage. You have to enjoy the privilege through leverage. You must be able to enjoy what? Freedom and profit. Okay, so swing traders are those that just take positions and leave it out. Trade for several days until they've actually taken or they're satisfied with whatever they've taken or they want to take. Now, of course, we have position trading. Position trading is another type of trading. And those that have trades, and these are those that have trades that last for several weeks, even months, or even years. Did I hear someone say years? Yes, of course. We have position traders that run their trade and leave their trade to run for years, for weeks, for months. Wow, that's patience on another level. They're not even bothered by volatility. They're not bothered by fundamentals, changing the direction of the market, because, like we keep saying, the market will always do what the market will do. Eventually, it's still play out in the direction you probably speculated. But of course, we would have maneuvered and have done different things during the course of the movement. All right, so position traders are those that have trades that last for several weeks, months, or even years. These traders know that fundamental things will be the predominant factor when analyzing the market, and therefore make their trading decisions based on them. Okay, so let's look at some terminologies in Forex. Terminologies in Forex. All right, first is base currency. The base currency is the first currency that appears in a Forex pair. The base currency is the first currency that appears in a Forex pair. This currency is bought or sold in exchange for the quote currency. Let's look at the example here. It's Euro USD. Euro here is the base currency. Euro here is the base currency. And you can either buy or sell the euro against this quote currency, the dollar, okay, for the Euro USD. So what is the quote currency? Of course, from what I just said earlier, you can actually take it. Quote currencies are referred to as it's also referred to as a counter currency. It's the second currency that appears in a Forex pair. So let's look at the Euro USD example again. This time around, the dollar is the quote currency. The dollar is the quote currency. Okay, we have another term called bid price and ask price. You must have heard me mention this, in passing, even the last class we had. Now you have the opportunity to know what they actually mean, or what I refer to by the bid price and the ask price. The bid price is the price that a trader is willing to buy a currency pair in real time. Take, for example, you approach the bureau by the roadside. You have $100 with you, okay? And he has some naira that he can give to you. You need some naira because you can only spend naira right here in Nigeria. So what happens? Okay, you would ask him, how much is the dollar as of now? And he says, okay, I'll just sell it to you for 360 or whatever, price. And then you go, no. I want it for this. So it becomes like a bidding price. What you're willing to buy a currency pair for in real time, all right? Because you're going to sell the dollar to him to buy the naira, then there has to be a bid price. The ask price, on the other hand, is the price that a trader is willing to sell a currency for in real time. The ask price is the price that the trader is willing to sell a currency for in real time. So when we're trading, since we are buying and selling currency pairs at the same time, we always have the ask and the bid price play out together. And so, because we have the ask and the bid price playing out together for every currency pair we trade, there must be a difference. It's never the same, hardly the same. That difference is what we call a spread. And that's what most Forex retail brokers, enjoy as commission. That's how they make their money to some extent, all right? So the spread is the difference between the ask and the bid price. This is what is charged by a broker. For example, if the dollar yen is quoted with ask and bid prices of 110.00 to 110.04, then this quote indicates a spread of what? 4 pips. Spreads or prices are measured in pips. We'll talk about that much later. It's one of the terms that we'd like to look into. So the dollar against the yen is quoted at 110.00 to 110.04. The difference is 4. That's 0.04. That's 4 pips. That spread is what the broker enjoys in leverage. So if price moves, in a certain direction, the broker is not bothered, as it were, because that spread is first what's charged. It's taken off that trade, while the trade is running. Position. Position is a term used to describe a trade in progress. Position is the term used to describe a trade in progress. A long position means a trader has bought currency expecting the value to increase, while a short position refers to a trader who sells the currency expecting it to decrease. A position is what you take. I'm about to take a position on this trade. What position am I taking? Am I going long or am I going short? Long means I am buying. Short means I am selling. Okay? So am I going bullish or am I going bearish? Sometimes, or most times, long trades, going long means you're going on a bullish. it means that you're buying. Going short means that you're going on the bearish, or it means you're selling. Okay, if we have to show you exactly what this looks like on a MetaTrader much later, then you would understand exactly where we see a bid price, where we see an ask price, and then of course the spread that is very much quoted. So another terminology to look at is pips. The unit of measurement to express the change in value between two currencies is called a pip. So let me break this down the easiest way you can understand. If you measure distance in meters, if you measure weight in kilograms or in grams, as it were, then of course in Forex, price is measured in pips. Price is measured in pips. That's how you calculate price. How many pips has price moved? Okay, how many centimeters is this rule? Okay, how many distance in meters am I from the house? Okay, so the same thing happens to price. You measure price movement in pips. So yeah, a lot of Forex traders use that term a lot. I've made 10 pips today. It means that I was able to move price in 10 points, by 10 points. 1 pip, all right, can make me money. 2 pips can make me money, depending on how much I have put into it in terms of my lot size, which we will look at much later. Okay, 3 pips can make me money. 4 pips can make you money. Do you understand that? All right, so the pips is of course the movement of price from one point to the other. For example, if Euro USD moves from 1.1050, and you can see a 2 there, we'll talk about that much later. For now, when you see currencies, they're always quoted in 4 decimal places, except for the JPY pairs. JPY pairs are always quoted in 2 decimal places. So Euro USD, you always find numbers in 4 decimal places, 1.1050. That's like the price of that pair at that time. Okay, that's the ask and the bid price. Okay, so the ask price is 1.10502. That 2 there is a pipette. It's called a pipette, which is very negligible. That's something you must note. Okay, it's a 5th number. It's very negligible. So 1.1050 to 1.1051. Okay, what has happened is that we have the difference of 0.001 here. If you do the math, I mean, this is the simplest of mathematics you can do. All right, that 0.001 dollar or pip rise is 1 pip. That's just that dollar rise is just 1 pip. So usually the last decimal place of a price code is what you pay attention to. The last decimal, or the last 2 decimal places, or 3 decimal places, or the last 4 decimal places. It depends on how many the volume that you're going for in terms of your lot size and all will determine. Okay, so but there are some exceptions, like I said earlier, like the Japanese yen pairs. They go out to 2 decimal places most time. So for example, the Euro USD 0.001 for a pip, but for the USD dollar JPY, it is 0.01. And like I said, the 5th decimal place is known as a pipette, which is usually ignored. You can see it here. That's why it's highlighted in the red here for me. It's just to let you know that it's ignored when you're calculating your pip movement. All right, the pip movement is only centered on the numbers here, the first 4 digits. Starting with the last number before the pipette. All right, that's what we focus on. Lots. Forex is traded in specific amounts called lots, or basically the number of currency units that you will buy or you will sell. Let's see how you can explain or you understand this. The standard size for a lot is 100,000 units of currency. And now we have mini lots, micro lots, nano lots, that are like 10,000, 1,000, 100 units. So for a micro lot size, for a micro lot of 0.01, that means if you're using a lot size of 0.01, you will understand that when we look into our MetaTrader and both for mobile and for desktop, You know, when you're going by a lot size of 0.01, it means that for every peak movement, you'll be making only 10 cents per peak. Somebody's going to say, ah, that's small, though. Ah, we'll grow beards before we build this house. Oh, no, come on, calm down. It's in the volumes, and of course, Forex is not just one day of trade. Many days of trade accumulated. The compound interest, the compound growth of most of this thing is phenomenal that you would even not even imagine. All right. So if you want to make more and use bigger lots, then you have to start with what? Bigger capital. So for those of you trading with like $100 or less, you know, you probably $200 or less. Most often, whenever you're going on, you know, going into the Forex market, you'll be using small lot sizes of 0.01 to trade. So it means that whatever position you want to take of buying that currency pair or selling that currency pair, for every peak, you'll be making 10 cents in that direction. If it's going against you, you'll be losing 10 cents in that direction. You understand that? For a mini lot size, it's 0.10, which is $1 per peak. That's when you've stepped up a little bit. People that can use this, you know, this average is saying right now, are those that probably are trading, you know, as much as maybe $1,000 or even possibly $10,000, you know, in capital. But of course, there are ways to go around this thing. Just telling you, there are ways to be able to calculate your lot size and all much later that will definitely teach you. Okay, so mini lot is 0.10, which is $1 per peak. So it means that if you are going for 10 peaks, guess what? You'll be making $10 at the end of that trade. It means that if you are in the stage that you would lose 10 peaks, then it means that you would have lost $10 at the end of the trade, should that trade have gone against you. So do you understand what that means? So peak is the number of points that price moves. The lot is what determines how you read the amount of money, and you calculate the amount of money you make per peak. So if you use a micro lot, you'll be making 10 cents per peak. If you use a mini lot, you'll be making $1 per peak. So that's why some people go for a lot of pips. They can go for 100 pips. If you go for 100 pips on a micro lot size, you'll be making, at the end of the day, $10 out of that trade. And the person who entered that same trade with you going for $100, guess what? Would have made $100 at the end of that trade. How sweet is that? How sweet is that? While someone who uses a standard lot size of 1.00, which is $10 per peep, for 100 peeps would have made what? $1,000 at the end of that same trade. So you can see that we can take the same trade, but the variation in our lot sizes determine how much profit we make at the end of the day. So he who has maybe $100 or less in his account, going for the same 100 pips would have made only $10. $10 plus his $100 capital is now $110, right? Not bad. That's your one trade. Okay? Remember, it's all about what? Getting rich what? Slowly. Okay? For the mini lot size players, what they're doing is what? $1 per pip. They would have made $100 at the end of that same trade. They have a capital of maybe $1,000, and then their new balance is $1,100. Not bad. What about those that have maybe $10,000 in their account? They're making $10 per peep. Same 100 peeps, you know, that they've gone for. Hello, at the end of the day, they made $1,000 at the end of that trade. So their new account balance will be reading what? $11,000. So that's how it works. We go for the same trade, but the profits we'll make is depending on how we're able to play in the market. What is my account size able to play? What account size you using that you're able to play in that market? Okay, so we'll treat more of this much later. Swap. This is only charged by the broker when a trade is left overnight. Yes, the swap is only charged by a broker when a trade is left. So those who go into swing, you know, positioning, they pay swap every day. There's a swap fee that is attached, all right, that is charged. So that's another thing that a broker charges you. And that means that they're charging you for, quote unquote, parking your money in their vaults, as it were. You know, for everywhere, even the handlers, they charge the airplanes, the airlines for parking the airplanes there. So The broker is charging you for managing your trade, for keeping your money for that position after 1 day. That's what it means. So they charge you for that. So beyond making money from the spread, they also make money from swaps too as well. Okay? And of course, leverage. We talked about leverage. Leverage is something that you must enjoy as a Forex broker, as a Forex trader, beg your pardon. And leverage is borrowed ratio that your broker is willing to allow you trade with. Bam. That's it. Borrowed ratio that your broker is willing to allow you trade with. So for example, if the broker is giving you 1 to 500, 1 to 500 as leverage, which is quite high, it means that if you are trading with a $50 account, it means you are able to buy currency pairs as much as 2,500 worth. So that's what leverage does. So you'll be trading that currency pair as though you have what? $2,500 in your account. Because for every $1, they are making you have $500 extra to trade with. So if you have $50, that's $2,500 you're playing with. Okay, so leverage is good. Leverage helps you to play big, but at the same time, leverage can help you burn your money or your capital pretty fast. So you don't take that, but you don't abuse the privilege that the leverage gives you. What is stop loss? Very quickly, stop loss. This is the marked and identified price level a trader specifies to be knocked out of a trade. It states how much that you're willing to lose should the market go against you in the opposite direction than you speculated. We told you earlier that a loss is all that you have complete 100% control of. And your stop loss is one of the things that helps you to protect your capital. It keeps you in the game longer than normal. Imagine you don't trade with stop losses that are meaningful or no stop losses at all. Before you know it, you're out of the game. All you need to do is take maybe 5 trades on your $100 account or even 2 trades and your account is burnt. But of course, with stop losses, you can take maybe 20 trades on a $100 account because you've been managing your losses, okay? You not using stop losses at all is a sin. It's a big sin. And of course, using illegal lot sizes is a crime. Using illegal lot size is a crime. Not using stop losses, a big sin. Take profit. This is an identified marked level specified by a trader as a potential point price, that price is envisaged to get to for profits to be obtained. So take profit. I've entered the price at this level. I'm hoping that I'm buying, and I'm hoping that the currency appreciates in value. And I put it that, okay, I want it to appreciate in value over what? 10 pips or 20 pips. And market moves in my direction in that same 10 or 20 pips. I would have set my take profits that 10 pips, 20 pips later take me out of the trading profit. That's what the take profit is. Stop loss is that, okay, in case the market goes against me by 5 pips, okay, which we will still understand much later in terms of ratio of loss to profit. We always do 1 to 2, 1 to 1, 1 to 2, 1 to 3. Okay, so you could say, okay, I'm willing to lose 5 pips of trade. So in case the market goes 5 pips, the biggest cut me out of the trade. So that's how you manage your trades. That's how you manage your profit. That's how you manage your capital. That's how you manage your, your wealth, as it were, as you build them gradually. What is entry price? Entry price is the exact market price of the currency as at when a trader takes a buy or a sell position in the market. I'm about to go into the trade. Euro USD is selling for so amount. Buy. The moment I click buy, that becomes my entry price. It means that if another person enters the trade 2 seconds after and trade is still at that same point, we would buy at that same price. It means that 5 minutes later, if the price had gone up and come back to where I entered and somebody still entered at that time, 5 minutes later, and price is back to where I entered, we could all still have the same entry points or have different entry points. Do we understand that? Current market price. Current market price varies as price moves. So I've entered a trade 10 minutes ago. Someone is asking me, can I still enter that trade with you? I'll say, check the current market price. What is the market price of that time? Where has price gotten to at that time? Is it too far away that you cannot get into the trade anymore? Or is still within range for you to still jump into the trade? That's what current market price is. What is a pending order? This is a futuristic position, automated and specified as the price to take a position should market get to that point. How do we mean? I want to buy, but I don't want to buy yet. I would rather buy when price gets to a particular level and still hope it goes higher. So what do? I would state that, okay, when price gets to this level, please pick me in that trade and take me and ride me to the profits that I in the sale. That's a pending order. Or sell me at this point, and when price depreciates further, knock me out. So that's a pending trade. We'll talk about pending orders much later. What's a bullish and a bearish trend or market? This is a term used to describe a certain trend of the market at different times. A market is said to be bullish if it's in an upward trend or upward direction, and it's bearish when it's in a downward, or a selling position. It's bullish if it's buying or it's in an upward trend, and it's bearish, when it's selling, or of course it's depreciated. So how do we make money trading Forex? Very quickly. How do we make money trading Forex? How do we make money trading Forex? In the Forex market, you buy or sell currencies. We've stated this over and over and over again. The objective of Forex trading is to exchange one currency pair for another in the expectation that the price will change in your favored direction. Okay? So more specifically, that the currency you bought will increase in value compared to the one that you sold, while in a buy or bullish or long position. Or that the currency you sold will depreciate in value compared to the one that you bought while in a sell or bearish or short position, or using the same terms. Those are like the similar terms used for the same, to meaning the same thing. All right. Of course, again, specifically that what you are saying is that the currency you bought will increase in value compared to the one that you sold. That means the one you bought, which is your base currency, would increase in value than your quote currency, while in a bullish or a long position or in a buy position. Or you are saying that the currency that you have sold, let's say it's the base currency, will depreciate in value compared to your quote currency that you have bought while in a sell or a bearish or in a short position. That's how we make money. So let's look at this example right here. This is a trader's action. This is the action taken by a trader. You purchase 10,000 units of euros at the Euro USD exchange rate of 1.1800. Okay? You purchase 10,000 units of euros at the Euro USD exchange at the Euro USD exchange rate of 1.1800. Okay? Now the euro is 10,000. The USD is what? 11,800. That's what it means, because this is the base. This is the quote. 2 weeks later, or even 10 minutes later, or even 1 hour later, or 15 minutes later, guess what happened? Our price has increased. All of a sudden, euro was now going for what? 1.2500 as against 1.800. If you now do the math, multiplying this figure by what? Your 10,000 units worth of euro, this is what you have. 12,500. 12,500. And you had 11,800 invested in that currency pair. 11,800 invested because you had 10,000 units of euro, and price of that currency pair was 1.1800 at that time. Some minutes later, some hours later, some weeks later, price had increased to 1.2500 right here for that same unit that you bought. And now if you multiply the 1.2500 by the number of units of euros that you bought, you have 12,500 units now. If you now take the difference of this from this, guess what? You just earned a profit of $700 because price moved in your favored direction. The same thing happens if the price had gone against you by this same figure. If it had gone against you by the same number of pips, guess what, guys? Oh my, you would have lost probably $700 to as well. So that's how you make money trading the Forex. That's how you make money trading the Forex. That's why when you get into a currency pair and you take a position, you make money or you lose money taking a position of the buy or a sell, envisaging that market will go in your favor and not against you. When can you trade the Forex market? That's the last thing we're treating today before the next class. When can you trade the Forex? I know it's true that we said the Forex market is open and never sleeps, 24 hours a day, 5 days a week. But that doesn't mean that it's always active like the entire day. Active it doesn't mean that there's a lot of volume, a lot of movement. You don't want to trade when there's no much movement or there's no volume. It's like a waste of time, and you're just in that trade for longer than usual, longer than expected. So despite the fact that the market is open 24 hours for 5 days a week, you still also need to play smart. Ask yourself, okay, so when do we have, some major movements, some volumes, all right? And that will tell you that there are movements and volumes at specific times within the 24 hours. The Forex market can be broken into 4 major trading sessions. We have the seedling session. The seedling session opens 7 a.m. in the morning and closes 4 p.m. in the evening, local time. But of course, our own time here, it's 10 p.m. to 7 a.m. That's the seedling session. The Tokyo session for our own time here, it's 1 a.m. to 10 a.m. That's midnight. So those are trading the Tokyo session. And so all the currency pairs within the Tokyo session are what you'll be taking at that time. The seedling session, of course, New Zealand and Australia, you'll be taking currency pairs at that time within that time frame and time period. The London session opens 8 a.m. in the morning Nigerian time and 4 p.m. in the afternoon. And of course, we have the New York session that opens 1 p.m. and it's all the way to 10 p.m. But of course, there's session overlap in between these, and we have very, very active times, within these, time frames that were defined in this session. All right, so a big thank you to those that joined us again for today's class. It's the second class concerning the basic, the fundamental training, Forex trading that we actually did promise. But of course, when next we meet, we'll be talking about the components of Forex trading and Forex analysis. The components of Forex trading and Forex analysis, which is the fundamentals, the technicals, the sentiments, and also we'll be looking at how you can select a broker tool as well. All right, so if you have questions concerning this class, you know what to do. Just hit us up with those questions on the Telegram group. On the Telegram group, hit us up with the questions on the Telegram group. That is Fortune Signature, and we'll try as much as possible to answer all the questions as posted right there. So thank you very much. You have yourselves a wonderful, wonderful day and evening. Remember, the Fortune Signature is about building a fortune trading Forex.